and good morning, everybody. I hope everyone's as caffeinated as I am. But very uncharacteristically, I was in bed asleep by like 10:45 last night. So I'm pretty, right? I'm pretty proud. Those of you that have done this stuff with John and I in Florida know that that is the exception to the usual rule. So my name is Mark Lopresti, as my colleague and friend Mr. Satter mentioned. The super short version of me. 28 years or so on Wall Street, ex-Lehman Brothers, New York Stock Exchange floor, institutional equity sales, 20 years as a securities lawyer, specializing in alternatives in the family office world. I quit practicing law about 3.5 years ago to focus on the family office that John and I started with a couple of other families, making Series C and Series A investments in a dog's breakfast of companies, which we can talk about. And focusing on my fledgling media career. John and I both have been doing CNBC, Fox Business, and a variety of other mainstream media, television, as well as various and sundry podcasts, radio shows, whistle stop tours, what they used to do with the trains. So we're media whores at the end of the day, but it actually has helped. And John's going to talk a little bit about that. I have one programming and housekeeping note. One of the companies that John and I recently took a stake in that we're really proud of and having fun with is bringing a piece of equipment here to APF. And starting at 2 o'clock, we're going to do demo flights for some friends in a Cirrus SF-50 Vision jet. This is the jet that has a parachutes, the safest and most advanced aircraft in the sky, AI-driven flight system. The only thing I don't like about this jet is that there's nothing for me to do. Because I'm an amateur pilot and like to fly. So we have some slots available. I don't want to interfere with pickleball, but we're going to do probably 3 or 4 demo flights between 2 and 3:15, 15 to 20 minutes, take you up around 5,000 feet, see Naples, experience the plane. So if you're interested, let myself, Alessandro, with the broken chicken wing, who works with me, and John, or of course, my lovely better half, the Honorable Sarah Suey. So moving over briefly to the digital asset discussion, and Dan and Mark suggested that John and I say stuff that was interesting, unique, that was sort of keeping things interesting, and we're known to keep things interesting, as you probably tell just by our appearance. So I'm going to tell you a couple of things, and I'm going to turn it over to John. So, okay, blockchain ain't going nowhere. Number one. Number two, we have to separate blockchain and blockchain technology from cryptocurrency, okay? Yes, blockchain underlies crypto, but what we're seeing is that everything that blockchain can do, from decentralization to Web3 enablement, to enabling content creators, to disenfranchising the incumbent oligopoly of Hollywood and the music industry, all of those incredible, wonderful, game-changing things are being thrown out with the bathwater of crypto in the wake of FTX and all of this other stuff. So it's super important for us as investors and people that have committed to the space to continue that education and separate out that false narrative. Okay, so that's one thing I'm going to say. The second thing I'm going to say is the biggest risk to blockchain and cryptocurrency's capability at scale, all right, is also the biggest catalyst. And what the hell do I mean by that, okay? Institutional adoption of a new asset class is driven 100% of the time by regulatory certainty and clarity, okay? So as you see regulatory certainty and clarity come into play with a new asset class, especially when it comes to crypto, institutional adoption increases, because compliance officers can decide whether this is fish or fowl. Is it a security? Is it a currency? Is it an option? What is it? So now I can buy it, put it in my client's portfolio. Okay? But simultaneously, because the SEC has done such a horrendous job, right, of regulating and doing what the SEC has done for many years, which is regulate through enforcement, terrible policy. Okay? And as a securities lawyer, I fought the SEC many times. And central banks, at the same time, are encouraged to keep the monopoly on the control of currency. So what did we see continue to happen, right? The UK just yesterday announced the appointment of a central bank cryptocurrency minister, first time ever. And the UK-based cryptocurrency world said, ooh, that's probably not a good thing. China went first in establishing a central bank digital currency, right, as a means to continue to control its population through currency control, of course. And the US will not be that far behind. And if you have any doubt about the timing of that, you only need to look at what happened 2 days ago with Custodia. Custodia was a Wyoming-based bank founded by Caitlin Long. Caitlin, I don't know if you remember, John was on the boat with us last year around this time. And we had very high hopes for Caitlin. She had the support of Senator Loomis. We had Senator Loomis's chief of staff with us that night as well. We had done a fundraiser for the senator earlier that night at the Ritz-Carlton. And everybody sort of thought Caitlin was the one that was in pole position to actually have, the first properly regulated, crypto bank, apart from Silvergate, which is not really crypto. And the Fed basically came out and said, just on Thursday, Friday, ain't happening. It's specifically citing risks associated with cryptocurrency. So we have a dichotomy in front of us where the biggest catalyst for adoption of cryptocurrency at scale is also the biggest deterrent, right? And that's regulation and the involvement of government. So I'm not going to answer the question. I'm going to turn it over to people that are a lot smarter than me. And I'm going to turn it over now to John. John, I know you've got some slides that tell a little bit more about who the hell we are. So here you go.
Sure. Thank you, Mark. We're going to go through the slides very quickly. And then we're going to bring up Sandy and Brooke and then Dan. And we're going to have everybody up here. You guys will get a chance to hear what they have to say. So we're not going to cut anybody short. But as Mark said, he and I have been, I created a trading firm in about 1983. I came to the Chicago Board Option Exchange in 81 from the Chicago Bears. So, Jack, I love what you had to say about pro sports. I want to talk to you later about the LA A's, because I think that's coming. And I was the chairman of a company that went public last year called Nauticus that is right in the same space as Proteus. So, except it's underwater repair with an electric vehicle, tetherless robotic and all that stuff. It's amazing tech. But anyway, what I do during the rest of my time is I trade. In the past, I would trade about $1 billion a week worth of stock. I had the good fortune of meeting Barry here last night, and a fellow trader. So just like Mark, it's always fun to hang around with fellow traders and tell war stories and things like that. But I had about a 70-person firm. We sold it to Citadel. I built another firm, sold it to Goldman Sachs. It's a high-frequency trading firm. And then I built up Option Monster and Trade Monster, sold them to E-Trade for $750 million, and I still resent that I had to sell it because I wanted to keep it. But with all that said, we've created algorithms. When you see Mark on television or hear either of us on podcasts or TV, tomorrow I'll be back on Fox Business with Charles Payne talking about that. Because last week when the stock was 136, we were talking about Tesla and how we saw big upside for Tesla. It traded an average of 111 million shares a day, November through December. All of a sudden in the past 3 weeks, it's traded 175 million. All you got to know is that if the volume is increasing, just go with the direction that they're going. And it had gone from 101 to 136 last week. Yesterday, or 2 days ago, it hit 180. So we killed it. That's a whole year's worth of profits in 2 days. That's my evil laugh. But anyway, so I love to trade. And I've got a company, Market Rebellion. You see it on the screen there. I'm not going to belabor any of that. Mark and my brother Pete and I have created a media company as well, where CNBC's ratings, by the way, have dropped precipitously. Some of it might be politics. Some of it might be the sort of guests they put on every day or whatever. I'm not, accusing. I'm just saying they fell so far that our streaming show on YouTube, Twitter, Spotify, and our own site gets more viewers on a daily basis than CNBC gets. And that's before we cut some media deals, which we're about to announce. So it's, by the way, right now it's Monday, Tuesday, Wednesday, Thursday at 1 p.m. Eastern Time. So if you follow me on Twitter or Mark on Twitter, you're gonna see it. Anyway, that's what it looks like. It's a lot like ESPN's, pardon the interruption, for those of you who are sports fans. I know a lot of pickleball players. But as you see, We have the stocks we're talking about here. We have a couple trades that we'll do here, and then a little bit of sports, all in 24 minutes. So it's bang, 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 a minute and a half on each topic. So we don't bore you, we don't extend it out and all that kind of stuff. We call that hush puppies, which are fillers for those of you who have ever gone to an all-you-can-eat buffet. They try to fill you up with hush puppies so you don't eat the meat. This is one that I want Mark to hit real quick because Wejo, this is a guy, an evil genius, but a nice genius, that created Wejo. One of the things that Mark and I do is we go promote companies that we've invested in, and then we said, everybody needs this though. Every company that Mark and I meet needs money, needs exposure, and needs connections. And if we just gave them money, that wasn't enough. So we had to go out and find somebody else to do it. So because we have media presence and all that, we can create the lift, whether it's public or private, and we can make the connections for them. So Wejo, this guy was a Formula One nut, and he knew about all the telemetry and everything that goes on with the automobiles. So he said, what if I buy, all of this, 13, 14 million cars worth of data, second by second, foot by foot while they're on the road. I can tell how the tires are doing. I can tell all this different information. How long does it sit on a lot? How long does it sit? How often does it get wrecked? All of those things, which are valuable to a whole bunch of verticals in that space. So Mark and I signed these guys up. We invested in them. Mark's helping them get a SPAC done for it. And this is a company you guys are going to see a lot about, Wejo. Already public, and I think since we talked about it 2 or 3 days ago, how much is it up, Mark? 57% in 2 days, because again, we can help with that lift. Not a pump and dump. We have not sold a single share. We think this thing's going significantly higher, and you guys know how SPACs work. SPACs are priced at 10, and then it depends on the redemptions and so forth, but this is gonna be cool. And then, there it is, that's the Verijet. You might notice that cruise missile rocket on the back of it. These are the most efficient jets in the air. Like Mark said, safety, they've got a parachute built in on top. They've got also AI that will allow you, if the pilot became disabled, you can just press a button on the roof of the plane inside the cabin and it will take you to the nearest safe airport to land at. And it will do everything, flaps, reverse thrust, everything when it does it. It's amazing. And those of you who want to go up today, we've got some demo flights like Mark said. It will be a heck of a ride. This, let me show you the interior because it looks like you're in, a Mercedes-Benz or a Bentley or whatever. It's a gorgeous interior with big screens that drop down and all that kind of stuff.
So John, some of us need a ride to Miami.
Well, some of you could ride with us to Miami then.
That's what I'm saying.
And because it's got the one jet in back, and the way the roof slopes, they don't get the bird strikes. They are approved for 1 pilot instead of 2, and it burns half as much gas as a comparable sized jet. Obviously a lot less gas than the big jets, so they can go all the way to carbon neutral with this by buying the offsets, and super safe, like I already mentioned. Anyway, with that all said, let's see, do I have one more slide? Yep. So then Mark mentioned that we do media. That's one we're going to record this afternoon again, bulls, bears, and blockchain. So that probably leads us perfectly into Sandy and Brooke, and then we can get to you, Dan.
Yeah, why not? Yeah, that's a show. Thank you so much, Sean. That's a show we just started. It's a radio show that's available on Spotify, et cetera, et cetera. We try to take the same thing, no bullshit. 3 stocks, 3 options, 3 cryptos, 1 macro. Try to do it in 20 minutes and not just droning on and about how SBF is a crook and blah blah blah. So I'm really happy to have and to introduce Andrew Hoppen, who is the CEO and co-founder of a firm called Chainlink Capital, which I've actually known about for a good while now. I invited Andrew to speak at my Battlefin. You'll see John's wearing the colors from the conference we just finished this past week. It's a company that's in alternative data that I co-founded and is another one of our portfolio businesses. We have a conference series Second one we do every year is in June. We rent the USS Intrepid. We have a thing for boats if you haven't figured that out yet. And I invited Andrew to come and join us and speak as one of the leading and few fund-of-funds in the space. Andrew was not able to come, so he sent his co-founder, Murat, who was an absolute gentleman and character and came in a fedora and black outfit and charmed everybody on the plane. But these guys from Chainlink are really one of the best. They have the second largest track record of all crypto funds in the space. They've been around since 2017. Been awarded #1 performing fund of funds by Crypto Funds Research. And Andrew, I don't want to just talk about Murat, Andrew is literally a rocket scientist, although you'd probably say I'm getting that wrong. He's a NASA-trained planetary scientist. A former CIO of the government, and Sarah, you might find this interesting, Andrew was formerly the Chief Information Officer for the New York State Senate, where he was awarded one of GovTech's top 50 in the industry. So, real pleasure to have you here with us this morning. Can't wait to get your view on what's going on with crypto in the world. And I think, of course, also Dan, who's going to be taking over the wheel for this conversation. Dan is a 361 affiliate. He has been an alternative specialist and a placement agent and marketer of alternative things for a long time, and a good friend of 361 and of ours as well. And I think, John, are you introducing Sandra and Brooke, if I'm not mistaken?
First of all, I want you to introduce me sometime, Mark.
Where? Oh, Mark Sanner.
You're not now.
Who doesn't know you, though?
No, but that was a great way to introduce.
Thank you.
You're going to kick off our events from now on.
It's $1,700 per intro. So it comes with a headshot.
It's very cheap.
It really is. John?
Because it comes with a plane ride, too. It's great.
Thank you very much, Mark. Brooke Pollock is the CIO of Hut Capital. I know Sandy is an investor in there, and now they're working together because she met a smart person. She told me whenever she does meet a smart person, she doesn't want to let them go, which is why she never calls me anymore. So that's that evil laugh again, Sandy, sorry. But Brooke is a founding managing partner of Hut. He spent 4 years with Green Spring Associates. Brooke was at Hamilton Lane, HLNE. It's a NASDAQ listed company. You already heard her better half, Chauncey, yesterday talking about his experience and what he had done at Franklin Templeton and so forth before they decided to basically focus on philanthropic endeavors and running their family office. So with this said, folks, we're going to let these guys take over. Who goes first? Is it? Oh, Sandy, you go first with Brooke.
Okay. Well, just raise of hands. How many people have invested in blockchain venture? Okay. And I know that, Mark, you had an amazing panel about venture capital a couple of weeks ago, and I know that they talked about the benefits of fund of funds. So I thought what we would do is, because we have 2 fund of funds up here, that maybe, I think the building of a fund of funds is an art. And maybe the nuances of what can make a great fund of funds or not. So with that, Brooke, this is the hero's journey. Can you pretty much just tell everyone your journey and when you built your firm, you were able to navigate all these rocky waters, how did you do it?
Yeah, certainly. Thanks, Andy. So my background, I started Hut Capital in 2018. Before doing this, spent a decade in the traditional private equity and venture capital markets. Worked for a large venture fund of funds platform called Greenspring that grew to 17 billion of AUM before selling themselves to Stepstone a year and a half ago. Spent time in the secondary world, trading private fund interests at Hamilton Lane, and started my career before that, helping family offices to invest in all sorts of private funds. So we covered the whole gamut of the private market space. So, had learned about the blockchain, the crypto space, due to some friends who are kind of early folks in the Bitcoin world. And I started doing venture full time in 2014, connected to one of those guys, and just walked me through why Bitcoin is fundamentally interesting. It was really the first time it clicked. There wasn't much for me to do with that professionally, but in 2017 we started seeing a lot of these blockchain venture funds emerge in a way that just wasn't there before. The volume, the quality, was significantly greater as the market grew, and really dug into the space back then, and just completely went down the rabbit hole, as they say, and became completely convinced that this space was the future. And frankly, too, just intellectually found it extremely more interesting and stimulating than everything else that we were looking at in the tech space. And being at Greenspring, had a very broad view of the technology world, so had a pretty good perspective of what was happening across the tech space. Back then, there was no one really to go work for to do this. I got Greenspring to do one investment in this space. It wasn't really a big focus for them, so I ended up leaving to start Hood Capital back in July of 2018. As one can imagine, that was a very interesting time to start a new firm in this space, right at the depth of the last crypto winter. So we've definitely been through this before. We survived last crypto winter, getting started in the bear market. And I mean, it's just incredible the growth in this space we've seen since then. So just to give some context, back in late 2018, there was a lot of infrastructure being developed, financial services around crypto, payments, but blockchain itself is just infrastructure. It's something to build on top of. And at that point, there was very little that had real usage being built on blockchains. And if we look kind of bear market to bear market, we've seen incredible growth in the application layer. That's something that gets us really excited about this space. Just give some data, back in end of 2018, kind of depth of the last bear market, there was basically zero decentralized finance activity. Basically financial services built as software on blockchains. Since then, that's grown to 50 billion of value locked in those DeFi smart contracts. The NFT space has gone from, again, zero to what it is today, with over 50 million of weekly trading volume, and that being a cyclical low right now. The stablecoin space has gone from less than $1 billion of stablecoin supply to over 100 billion and over $1 trillion of annual transaction volume. So the growth we've seen has been incredible. I think the way that we've approached this is to be very early stage venture focused. This is a highly cyclical category. It has very unique cyclicality as an asset class. And we don't want to be timing the market, right? We view this as a long-term, early stage venture strategy where it's like, okay, where's the world gonna be in five years, 10 years? And investing in early stage projects, investing with funds that are backing the really exciting early stage projects across the blockchain space, who are going to be big players in this ecosystem in 5 to 10 years, and not worrying so much about the interim volatility. So I keep going, but I'll stop there for now.
So I know that you have a portion of your career with secondaries. How important do you think that will play?
Yeah, so a year ago, not important at all. Secondaries are a space you want to be in when there are forced sellers and people need liquidity, because if you're buying secondaries at the top of the market, you're going to be paying bad pricing for it. Right now, we have seen a big pickup in secondary activity. So as I mentioned, Hamilton Lane and Greenspring built out their secondary business. Has spent a lot of time in the past decade in the secondary world. Something I'm quite keen on. And in the crypto space, we've seen a lot of people looking to sell crypto fund interest, blockchain venture fund interest. People who either, one, need liquidity, just are basically forced sellers. Two, people who, let's say, kind of like FOMO'd into funds back at the peak of the market, but really didn't fundamentally believe in what they were doing, and now are kind of on the opposite end of that. And I think that's the wrong thing to be doing. But we're definitely seeing that. We've seen a big pickup in secondary interest. Folks who are willing to take big discounts because they need liquidity, or they just basically want to reduce their unfunded liability within this space. So that's been very compelling for us. We've been looking at a number of those opportunities recently. Likewise, on the direct secondary side, you actually bought a direct secondary interest a few months ago. For a lot of those, like the companies that see a lot of volume in the secondary markets, frankly, are not ones you want to be buying. You need to be very prudent around which companies you're interested in. Buying something at a 50% discount to something that traded at 100 times revenue still is not that compelling. So you can't just look at, oh, hey, what's the discount? Like, what's the actual valuation? What's the fundamentals? And decide if that's compelling or not. So we still see somewhat of a bid-ask spread there. I think that'll come down as this market, the bear market continues. But yeah, something we've been spending a lot of time on recently.
So you're a venture fund of funds, and you are a hedge fund of funds and liquid venture. When I first met you, I know that you were very diligent of really wanting to invest in closed-end funds and not open, and also, I don't know if many of us have seen the surgence in hybrid funds. So can you talk a little bit about that and why?
Yeah, certainly. So, I don't think there's a right or wrong way to approach the crypto space. But as an early stage venture strategy, we have chosen solely to invest in closed-end funds, and just fundamentally believe that if you're looking for early stage venture exposure, that is how to do it. On the hedge fund side, there's plenty of opportunity in terms of arbitrage and trading strategies. We are long-term investors, long-term fundamentally long this space, and I think if you're doing early stage venture, you're primarily investing in private rounds. So it's early stage equity, early stage token investments. And what we find is that helps to get rid of a lot of the market timing risk and cyclical risk that people find in this space. So if you look at some of the funds that we work with, they invest in early stage protocols. Those protocols then launch. They have tokens that might trade, at least some of them might. And some of those are down a fair amount for the past year. But because they invested in these really early stage private token rounds, they're actually still up quite a bit overall, just not the same level of gains as they had before. So from like a downside risk perspective, we think that's a huge benefit of doing early stage venture. We've seen a number of these hybrid funds out there. That's like, okay, we're liquid venture. We have the benefits of liquid. Who doesn't love liquidity? But we're also venture capital, and I fundamentally don't believe that really works as well as it sounds. It's a great marketing pitch, but if you're doing early stage venture, if you're investing in equity by default, that's going to end up being long term. Even doing early stage token investments, most of those, they're private. They end up launching. They're going to have a lockup thereafter. By default, they end up being long term investments, even if they have earlier liquidity versus equity. And hybrid funds end up investing primarily in liquid assets, and also have a lot of operational risks in terms of retaining talent over time in such a cyclical asset class. A lot of them have a bit of a mismatch between the assets that they hold and the redemptions that they offer, and they basically end up being hedge funds with long lockups, or liquid asset funds with really long lockups. So you often don't actually get the liquidity benefit that you might think you're having.
As a lawyer, I helped try to create some of those, right? And we call them interval funds because some of them were like 40 Act registered. And I have to completely agree. There winds up being fundamental mismatch between duration of holding period, redemption, and liquidity provisions with respect to what you allow your investors to have, as well as the expected time for exit. And I've also found that the operational expenses of hybrid funds are 2 to 3x that. The audits tend to be twice as expensive, if not 3 times more expensive. The regulators, I don't know what the hell this is. What are you? Are you a hedge fund? Are you a venture fund? Are you long-term? Or are you short-term? So I totally agree with that. The other thing I'm gonna just comment on is the secondary marketplace. I think we're seeing the evolution of that as it gets to scale, again, with institutional adoption, which always drives scale of new asset classes. With platforms like Forge, who we actually had at Battlefield with us just this past week. I know, Andrew, you guys know who they are. Where you're starting to see that negative selection bias with secondaries begin to decay, which I think is good. But I want to turn the conversation over now to Andrew, and to your very excellent point. We have 2 very different kinds of funds and fund managers here that I'm sure see the same tailwinds and headwinds in their space, but impacts their respective portfolios and investment strategies differently. So, Andrew, tell us a little bit about how you and Murat and Chainlink think about the opportunity set and the challenges that face the industry right now.
Thanks, Mark. So I'm going to agree with a lot that was already said, except for the liquid venture point, and I'll come back to that at the end. But we are a liquid venture hedge fund of funds, and I'll talk about why we think that is, in fact, one of the great ways to get exposure to the space. Just to back up a little bit, though, I agree a lot with your intro, but the three key things about why to think about this space now are, number one, you get paid to take the risk. A lot of people lost money last year. That's not a good thing, but you get paid for it. And this isn't a pitch, but there are a lot of funds like ours that timed it terribly. It sounds like we timed it as badly for inception as you did, Brooke, in the last crypto winter. Went through all that, just went through FTX last year. We still beat the pants off the S&P by more than 75% since inception over the last 5 years. So you get paid to take risks, number one. Number two, I think history is going to actually look back at FTX and say it was a great thing for this industry. Not only because it clears out bad actors, not only because it pushes good regulation forward, which I 100% agree we need, but also because it put a finer point on why this technology is actually useful. Meaning FTX was a centralized purveyor of cryptocurrencies. And yeah, a lot of people trading cryptocurrencies got hurt, but they didn't actually use the technology, the blockchain technology, which in fact, ironically, but importantly, is all about transparency. It's all about eliminating counterparty risk. So you're seeing a lot of market activity, therefore, move to DeFi now that was previously, because frankly it was just easier and better understood from traditional centralized ways of trading cryptocurrencies and their derivatives and all the lending and borrowing that happens in association with that. So I think you'll look back at this as a turning point to where the technology is actually used by the service providers in the industry for what it's good for, and that will actually help the industry long term. And the third and frankly most interesting thing to me as effectively a venture capitalist, even though we're a hedge fund structure, is these technologies, as you said, based on blockchains, are not going away. In fact, they are the foundation of the next wave of the internet, where Web 1 was read data. I'm old enough to remember Yahoo. Web 2 was social media, Facebook, Twitter, everything most of us are doing today. Web 3 is all that plus ownership. So blockchain technology brings ownership rights and privacy rights to the internet. And in a few years, we're going to start calling it more and more of a metaverse, and it'll be more immersive and all that. Yeah, but really what's fundamental is we can own our data and we can own the products and services that are built on these technologies instead of having centralized oligopolistic companies, if that's the word, 10 or 15 big players getting the value from us where we effectively are the product. So that's what's exciting to me about this technology, and that's why it's not going away. And frankly, it's going to be bigger because it's going to be more immersive than anything that we've called the internet up to date. And so for me as an investor, you have to have exposure to that.
So just one quick thing before I turn over to Dan. I don't want there to be a misconception that hybrid funds are the same as liquid venture, right? So you guys are specific in what you do in terms of duration and all of that. So explain just in a minute or two for those that don't know, what is a liquid venture fund?
So venture investments in crypto almost inevitably have to include the token that is a fundamental part of a decentralized product built on a blockchain. So when your product launches, a token is fundamental to the functioning of that decentralized product. So you're going to get it as an investor unless for some reason you choose to opt out of it. In addition, in some cases, to equity in a company. But in many cases, these are decentralized products that don't actually have a company with an equity cap table behind them at all. So a token is the only way to participate. So you're going to get that like it or not. And there is liquidity in that token, even if you have strings attached, like a lockup, as Brooke said. So you have to manage a liquid portfolio if you're a VC in the space. You have to be good at that. And that can include hedging against that. You can hedge an analogous token, even if you can't sell the token you have, go short it and effectively take risk off the table if you think that's a good thing to do. You may also want to double down because these tokens exist as part of the product, and actually staking those tokens, making liquidity available to, say, like a decentralized insurance protocol or a borrowing and lending protocol, can actually give you greater rewards than your initial token allocation did in the first place. So you got to be a liquid portfolio manager and a VC in order to do this well in this space, in our view. So why not also have the liquidity optionality of doubling down and taking risks off the table as an investor? So we just make that available to our underlying investors by investing in hedge funds that do mostly early stage venture as their strategy, because they're all doing liquid anyway. And you're absolutely right, it's very complicated from a cash flow management and a governance perspective, but we just think it's worth it.
I appreciate that. And the hybrid funds that I was talking about earlier were sort of in traditional assets, right? And these interval funds where they said, well, let's have distressed real estate portfolios and hedge and currency portfolios, and that hasn't worked. But Dan, I don't want to hog the microphone for too long. I know you've got some questions that you want to ask our panelists as well as some questions for the audience. So here you go.
All right, thanks, Mark. So I've got a couple questions from the audience already. I'm going to put a couple to Andrew. I'm going to call on somebody from the audience to ask a couple more. But this is your cue for you guys to start thinking of what you guys want to ask the panelists, and then we're going to wrap up and get to that admittedly fun thing called pickleball. I hope we got some Greek mythology fans out there too, because this is a real hero's journey. So, Andrew, if we could just clear up some confusion right away. I already got this question from the audience. Any associations to Chainlink Network, Luna stablecoin, or anything else you want to get out of the way right off the bat?
Yeah. So we like to think we're very good investors and we have a good track record. We're terrible branders because we named ourselves Chainlink Capital Management. We started a fund called Chainlink Luna Fund. We have nothing to do with the Chainlink protocol or the Luna token, neither of which anybody, including ourselves, knew much about in 2017 when we came up with this. That is what it is.
Okay, great. So let's get to the meat of it. Mark, you originally mentioned some adoption trends, regulatory trends, and how that's a double-edged sword. So Andrew, do you want to build a little bit on the regulatory and the adoption trends in this market and why that's exciting?
Yeah, so Mark said it well. I mean, regulation is fundamental to trust when you're dealing particularly with human beings and any kind of governance regime that is not in software. So we need it. We need investors with capital that comes from regulated entities in particular to be able to come in. We need to be able, capital to be able to go out. So those on-ramps and on-ramps in particular are fundamental to regulate and regulate well and centralize service providers to this industry better than FTX. Now we've got Fidelity Digital Assets and many much more credible players doing it are always going to be an important part of this industry. But what's really important in terms of regulation is the nuance. We have, for a reason, because we have counterparty risk in particular, we have regulations, we have oversight of centralized financial entities, and yeah, we have the Bernie Madoffs, and yeah, we have the Sam Bankman-Frieds, in spite of all that. When you're talking about moving a lot of these products and services to code, to software, where there is no human counterparty risk, doesn't mean there aren't risks. There are huge risks, hacking, security, and otherwise, and it doesn't mean those risks shouldn't be evaluated by regulators and regulated, but it needs to be done differently, because otherwise we're going to squelch innovation, and we want this innovation to happen here in the US. So we need good proactive regulation that is informed by these experiences and understands the nuance between what this technology can do that is not the way we've always done things, and also what still is necessary to do from a regulatory standpoint. And that's tough. We have to be there, we have to advocate, we have to be educated, and we have to go side by side with regulators and politicians to create good, nuanced regulation.
Great. So speaking of those risks in post-FTX, can you tell us a little bit about why the fund-to-fund structure, a little bit about Brooks' challenge, and also comment a little on the timing, why that structure now, given the risks that we've just been through, speaking of the hero's journey?
Yeah, so as I infer, Brooke did as well, came through pretty unscathed from FTX. It's partly, frankly, this just the strategy being early stage venture. You're not likely to have a lot of crypto assets on centralized exchanges. But a lot of people got hurt, a lot of funds got hurt, a lot of funds shut down thanks to FTX. We would never have that scale of risk if we're doing our job because we are inherently more diversified as a fund of funds. So we pay attention to diversifying every way we can, and when you're in a very early, under-regulated asset class, you need to be diversified. And if you do that well, you don't get taken out by an existential risk, and you get paid to take that risk, we think, on the upside, so it's worth it. So diversification, though, is also important from the standpoint of exposure. There's so much happening with this technology across so many industries. You need to be specialized to be a good early stage VC. You can't do it at the level of like blockchain technology. I'm a blockchain VC in our view. You need to do it at the level of the verticals and the industries that are affected by this technology. So it's very hard for any single fund manager to be specialized enough to be really good in being the best deal flow in each of these subsectors. So you want a diversity in order to get comprehensive exposure to the space. And then finally, in terms of timing, we launched at the worst time possible going into the last crypto winter in 2018. and have still done well on an inception to date compared to any other asset class. So, but the people who came into our fund in like late 2019, early 2020, have done multiples better. And the lesson, we think this is a cycle that's repeating. The lesson that we've learned is at the tail end of a bear market is a great time to invest in early stage venture because you got low valuations. Because there's liquidity again, you have the ability to pick up assets less than book value in some cases that are still effectively early stage projects without the strings attached of lockups and such. So it's a really good time. Our underlying venture managers are really excited about investing right now and have reloaded their portfolios over the last 6 months. We hope over the coming year to good effect.
Great.
So, can I kick off the first audience question in 60 seconds? Because I want to hear from both of you. Bitcoin and Ethereum has been resilient throughout this FTX nightmare and has in fact crossed over 23,000 and seems to be maintaining those levels. Is this a bull run or a bull trap, and why? 60 seconds, you first, Andrew.
I think we're back to levels that make sense. I think we could see lower lows, but it would be related to macro, and it would be related to bad earnings and those sorts of things rather than a sector-specific event. We don't try to time the market as early stage VCs, although we know that at the tail end of a bear market is a good time, better than at a market top, obviously. But the real point is these technologies not only are not going away, but they're fundamental to the future of the internet, and we want exposure regardless of that timing. So we frankly don't pay much attention to that in terms of what level those assets are at. It's nice though to see that obviously there's renewed interest in capital flowing back into the space. One last thing I'll say on it is, we watch the capital flows, that matters, yes, but what really matters is the talent flows. And like the contributors of code to blockchain projects is at an all-time high, and basically didn't miss a beat during the bear market. So that's the signal to pay attention to in terms of whether this is a healthy industry and ecosystem, not the price of Bitcoin or Ethereum.
Great. Brooke?
Yeah, I mean, for Bitcoin and Ethereum specifically, you know, they already gone through a lot last year. FTX, you know, Sam sold a bunch of money. It has zero fundamental impact on what Bitcoin and Ethereum are as assets and what they offer. Just happened to be in the same industry. So, you know, we wouldn't expect that to have material impact. Short term, you know, you saw Bitcoin and Ethereum go down quickly, and yeah, I think we've probably seen the bottom from a crypto cyclical perspective. We're not traders, but you know, we see valuations on the private side that are very low right now. The whole dynamic between investors and founders has, you know, shifted drastically. Where a year ago, founders drove everything. They got the valuations they wanted. They raised what they wanted. You know, people are throwing money at them. Today is the exact opposite. So, you know, capital is scarce. Valuations are very compelling. So, you know, whether we've seen the exact low or not is always hard to say. But, you know, from a valuation perspective, we think it's a great time to start deploying.
We have a few other audience comments, questions, and one is Bill Deichler, and then Mary, and then Safa, and then Andrew. And then we have to go play pickleball. Go.
Great presentation, good recap on everything. Going back, looking at institutions, and the institutions that I was involved with, getting involved in the blockchain space, and even the small pension fund that I'm a trustee on has had conversations about it. And I think a lot of their motivation for that was investing in innovation, in the sense that that is where the growth is. And the other side of that was the asymmetric opportunity that blockchain offered. Unfortunately, we've sort of seen the downside of the asymmetric opportunity. But I think, you know, one of the biggest difficulties for a lot of the conversation that's going on among investors, certainly in institutions, is the pall that's happened because of FTX. So let's turn the corner on that. And you know, my question for you all is, where do you see things 2 years from now? What are the emerging trends? What's the innovation that investors can get excited about today that hopefully we'll see, you know, some realization, you know, coming in the next couple of years?
We'll start with John, maybe 60 seconds across the board.
I'll do it even faster. POAPs. One of the things that Mark and I are working with right now is basically people that watch the videos earning tokens and so forth for that. Web3 makes that just a fabulous thing, and I'll let Mark speak a little bit about it, but that and the utility of Web3, rather than just Bored Apes, a utility that it especially works for what Jack's got back there. You're going to see utility across sports and across entertainment like crazy, because it's a way of rewarding their fans and growing the fan base, and everything from merchandise to tickets at the events and all that sort of thing.
Yeah, so I strongly agree with John. We actually just invested in POOP on the direct side of our business, so we're big fans of what they're doing. Likewise, seeing every big brand getting into this space in the NFT side. Recently saw, Nike, Starbucks, Amazon just announced they're going to be getting in the NFT space. Continue to see huge activity from large brands on that side of things. We definitely expect the decentralized finance category to continue to grow. Some of the application layer side of things I talked about earlier, including stablecoins. We're going to see a lot of the really first gen blockchain-based games that are not just like crappy, Axie Infinity type of games that no one actually wants to play, but like real AAA high-quality games launch this year. So that's something we'll be watching, and we think will drive a lot of activity as well. We've seen some emerging categories such as social, the kind of crossover of AI and blockchain, which is quite interesting, and likewise, kind of the intersection of physical infrastructure and blockchain, where we've seen a lot of new startup activity recently. So we think, 2 or 3 years down the road, will be a much more robust category as well.
I have a good news and bad news. Good news is I agree with everything that you two just said, and I think we're going to see 2 years from now the use of metaverse. Another company John and I are working with, I can't say the name right now because it's material and non-public, has just completed the creation of metaverse platforms for some of the biggest brands you've ever heard, and it hasn't been announced yet, but it will be. So the increased adoption by traditional Web 2 brands, top well-known brands of Web 3 applications, metaverse, increasing into the esports and video game space, totally, completely agree. For cryptocurrencies, however, we have to look at it against the backdrop of where will we be from a legislative perspective for the next 24 months, Bill. And I think we all know the answer to that question. We ain't going to be nowhere for the next 24 months because Congress is not going to do anything the way that it's currently comprised. So I see, unfortunately, a continued path by the SEC regulating by enforcement, which sucks for the industry, not offering the clarity that the industry is desperately looking for, and the U.S. losing out from an incentive perspective, a talent perspective, because people will continue through necessity to conduct geographic regulatory arbitrage and go to places like Switzerland and others to really innovate on the crypto side of things. And my hope, so good news, bad news, and hope. My hope is that what I started out by saying, which is crypto is here, blockchain's there, and everything blockchain enables, that narrative will become part of the common discourse, because right now it's not. It's all together.
So it's a really boring panel and everybody agrees, but basically I'm going to go a lot deeper on NFTs because I think everyone's right. Very briefly, the other area to look at in the very immediate term is just immense activity in what's called layer 2. So on top of Ethereum, building scaling and security solutions that enable you to do interesting things with that layer 1 of Ethereum. But that's in the very immediate term. That's sort of top of mind for most developers. NFTs is just where I think it is ultimately almost all at, for 3 reasons. And the beautiful thing is they're sort of they're sequential in time. One, today, burgeoning, digital art and collectibles and major brands coming. Big tech is all coming. Facebook, Meta, Amazon, on and on and on. They're all doing it now. Midterm, though, it's going to be much more relevant to all of us that don't necessarily care about that much, which is we're gonna log in with our Ethereum ID, which is my Ethereum address is itself an NFT. And is unique to me, and I'm going to stop using Apple login, I'm going to stop Apple ID, I'm going to stop using my Google Gmail login, I'm going to not use my login.gov from the federal government. I'm going to use my Ethereum ID to basically authenticate myself to everything in ways that I control in terms of what metadata gets shared and what metadata does not. And so I think it's going to be relevant literally to everybody in this planet, extratutionally as well, not just, say, in a political geography like the United States. Then finally, and ultimately, and the biggest deal of all, I think, is that most assets in this world are not fungible. Not only financial instruments really are fungible. Like you give me $1, I get $1. It's fungible. But I can't give you my birth certificate and get back your birth certificate and have it be the same. I can't give you the title to my house and get back the title to your house and have it be the same. It's non-fungible, it's unique. NFTs are the way that we represent that ownership layer on the internet, both for digital assets, yes, today art and collectibles, and tomorrow for my identity and all the metadata associated with it, but ultimately for everything, including in the real world. We're gonna replace everything you think of as having title with NFTs, and we're even things that are not, you don't think of as being titleable intangibles in the future. So NFTs have a long, long arc to go, and they're gonna be bigger ultimately than fungible tokens, which is today about 97% of the market cap of crypto. So it's gonna be a big flippening happening with that within the next 5 years, I think.
And one more audience question.
Yeah, this is a question for Andrew. It's a very quick question. During this whole crypto mess, did you have a lot of requests for redemptions? And how did you handle that?
No, and I'd say 3 reasons. One, we didn't have a lot of exposure because, as I said before, as an early stage venture investor, we don't have a lot of assets on centralized exchanges like FTX. Number 2, most of our investors honestly have been with us through multiple cycles, not just this one, and so they've got a strong stomach. They are not putting their rent money with us. They're long-term investors in spite of the liquidity that optionality that we do have. Inflows slowed down for sure, and I will tell anybody who will listen that this has been a great time to invest, but it certainly hurts us from a marketing standpoint, but not much at all, frankly, in terms of redemptions.
All right, last question, Safa. You're not dressed for pickleball, by the way.
This is to Brooks or Andrew or anyone else. Any thoughts on blockchains that don't use token? And do you think their application, especially in the industry, outside finance and outside trading with each other, do you think there's bigger application for those, such as in supply chain?
Do you want to get?
So honestly, no, that doesn't get me very excited. A blockchain as a distributed ledger and technology, the token is not just some asset that people can trade because people like speculating on things. It's a fundamental importance to the functionality of the blockchain for security. So stakers or miners and validators, they get paid in the native asset of the token. And when there's no centralized management in charge of this infrastructure, you have to incentivize third parties to do all of this, and you have to incentivize them financially. And being able to do that requires this asset. So if you look at a closed-end blockchain or a private blockchain, we really haven't seen a whole lot of success, frankly, and growth in that side of things. They're not incentivized to bring third parties in. It's kind of just within a certain group, and people aren't really incentivized to do the work to make the blockchain function. So, the asset that any layer 1, layer 2 blockchain has is fundamental to its existence, and we think that's a key reason why private blockchains have not been very successful.
I did say you could make a comment. Introduce yourself if you don't mind.
Sure, yeah. I'm Patrick Dietzen, CFO, co-founder of Orchid. Orchid's an older project in the crypto space, so we've we started the company in 2017, launched our product and asset in late 2019. It's a decentralized VPN. So been in the space a long time. One comment to make about like a closed blockchain is I have seen interest in creating like a permissioned blockchain for DeFi, so institutions can trade with each other and do the KYC AML. In particular, I think Avalanche was looking at that with a consortium to do it on like what they call a subnet, which would be kind of like a separate blockchain that uses the same technology that Avalanche uses for the main blockchain.
Yeah, but just one quick comment there. We've seen the same, and I think one key risk for people who want to trade on centralized venues is that if you don't have to do KYC and AML, you don't really know who you're trading against, even if it's technically a protocol. People view that as a regulatory counterparty risk from an institutional perspective. So the KYC, AML, having these permission pools, I think gives more comfort to institutions to trade on decentralized venues. So definitely definitely seems like that's going to grow. Like philosophically, I'm not a huge fan of introducing that into decentralized DeFi, but I mean, it's definitely going to grow and be a thing. So we'll see more of that.
All right. Real quick.
Well, just to follow up as well, one very interesting application is a company called Figure Technologies out of San Francisco. They built a private blockchain and are putting home equity mortgages on that blockchain. And the way that they've designed their company is as a base layer for securities transactions. And this is a true business application of blockchain, where there's not trading, there is some value in the token that is required to do the transactions, but it's really looking at a business problem and how can you use blockchain technology to facilitate and reduce costs with regard to transactions. It's a fascinating company, don't have time to go into it, but I think it's what all these people are really driving for. And so I'll just leave that one out there for you all to take a look at.
Okay, we're going to transition. So we're going to put two slides up. One is tonight. Again, John and Mark and others are co-hosting on a yacht. Do you guys want to give a word about that?
Mark? I've been doing all the talking this morning. All right.
Yeah, we're going to be flying back to Miami on that jet, that Verijet that you see up there. We're going to be flying back on one of those. For those of you who do want a demo flight, starting at 1, Mark, is it? 2 o'clock, we're going to have a couple go-arounds for people that want to feel what it's like to sit on that one. But to Mark Sanders' point, we have a party on one of our yachts in Miami, right across from the Fontainebleau. So those of you who are making the trip across Alligator Alley or flying with us, that should be a fun time tonight. What time does it open, Mark?
6 to 10.
6 until 10. And then we'll be with 361 tomorrow at
The Confidante.
the Confidante.
The only thing I'll add to that, John, is an email was circulated with the registration and a phone number if you wanted to join us on the boat. We do, there you go. We do have restrictions from the Coast Guard on how many people on board, as I found out the hard way about 3 years ago when the boat was listing like this to the side, and they almost took the keys away from us, which they probably should have, but we were at the dock. So we do sort of need to know if you're coming and let you know about availability. And the last thing I'll say, you didn't tell us what time you're going to be on with Charles tomorrow, at 2:15?
2:15 tomorrow afternoon. I'll be on
Fox Business.
Yeah, Fox Business, following up with Tesla and a whole bunch of other trades we've done. Jack?
John, don't forget, Bengals at 6:30.
Bengals Chiefs. We'll have.
I'm taking both dogs, San Francisco and the Bengals.
That's what we want.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.